Hello, traders. Gary Wagner here just before 2 o'clock in Honolulu, 7 o'clock in New York on Thursday, 2nd day of December, 2021. And this is the daily report for gold and silver. We saw gold continue its dramatic downside spiral, with silver actually gaining nominal cents on the day. We'll cover the differences between gold and silver, as well as giving you our short-term outlook on both based upon the technical indicators we are currently looking at. Gold continues to trade under pressure, now breaking through and closing below only slightly a key level, the 38% retracement at 1770. As it stands, February futures are down $14.60 and fixed at $1,769.70. It traded to a low today of $1762.20, and it traded to a high of $1785.20. While today's downward spiral had little to do with dollar strength, the dollar is up but only fractionally under 0.1%, with the index currently fixed at 96,115. As we have been speaking about over the last few months, today is yet another example of the further divide or disconnect between gold and silver pricing. Whereas gold moved down substantially, silver had a nominal gain almost 7 cents and is currently fixed at $22.40.5. While fractional dollar strength had very little to do with today's sell-off in gold, one of the underlying forces is strong moves in U.S. equities markets. The S&P 500 index gained 1.42%. The Dow Jones Industrial Average gained 1.82%, with the NASDAQ Composite gaining but the least percentage gain, up 0.83% in trading today. That took the focus off safe haven and put it back upon risk on. This first chart that we are looking at is a 15-minute line chart, so we can see the activity through the evening session in Europe as well as the open in New York. I've set this to New York time, and this represents 9:30 in New York when gold begins to trade. The massive selling that occurred in gold occurred prior to the open in New York. If anything, during the New York session, it tightened up from approximately $1,776 to just over $1,770 per ounce. We can see that trading has resumed overseas. It is currently fixed at roughly the closing price in New York, which of course is that current pricing is at $1,770.60, although it's showing a net change of about $7.80. Realize by the time we're looking at charts, New York has been closed for a couple of hours. The most important aspect as to where gold closed and is currently trading is whether or not it caused any chart damage. While I won't say it has been major damage, we have been addressing this long-standing support line is a key and critical area we need to see gold prices hold if there's any chance of some sort of quick recovery and move above 1784.60, which is currently where we are pegging resistance. Clearly, gold prices closed below that key level and is currently trading up a little bit at 1771, but still below that price point. If we continue to see pressure in gold pricing, obviously our next target has got to be at 1757 to 758, and that of course matches the low that occurred on November the 3rd. To look at further declines in potential support levels, we really need to either look at a weekly. In attempts to look at the big picture, we have created this weekly chart, and on this weekly chart we have three distinctly different time cycles for our data set. In blue is the shortest of all of them, which simply covers the last leg of the rally, which began at the beginning of November when we had gold at 1757 up to this top at 1879. What is clear is that downside pressure not only took pricing below the 78% retracement, but took current pricing to the next key level we need to watch, which is $1,770. Because that particular price point has a very, very pure Fibonacci harmonics. And the way I've defined the term harmonics is when two different size data sets have important Fibonacci numbers that occur at or around the same price point, in this case, within $40. I draw your attention, and these are both longer-term Fib retracement sets, but we have a 61.8% Fibonacci retracement at 1771 that corresponds to the 23% retracement at 1771.50. First of all, the longest data set begins at the record high of last August, and that is the point in time when we had gold at 2,088. It goes all the way down to the flash crash, which occurred in August of this year, and also matches the double bottom that we saw in March of 2021. When we do that, you can see that we're looking at these as a red line, and that represents the 23% Fibonacci retracement. When we compare that to the second data set, which begins at 1918 or 1920, the top here, the record low of the flash crash also at 1680. The fact of the matter is, when you have two distinctly different data sets with different time cycles, and they both concur that this particular price point is important, it is something to pay extra attention to. So what are we looking at? It has clearly closed right at that. If we continue to see downside, which I believe is quite possible, we would next look at 1732 as a level of support, with the major support coming in at $1,680. We're looking at the same chart we just had up. However, in this case, I have added Bollinger Bands. And Bollinger Bands are effective in finding ranges within a market's move. It also correlates to $1,732 as a potential support level in gold. In terms of resistance, major resistance, that is 1857, with the middle key coming in at 1785. We have already identified that as a key level. That's the key level that we took out in trading today. So we've got multiple techniques, both Eastern and Western, confirming the same price points. It indicates that we could see more downside pressure. Our next level to watch is 1757 and 1732 below that. We've been looking at Heikin Ashi charts all week to gauge the strength of the current trend. Obviously, the current trend has been down. We spoke about the fact yesterday that we could be seeing the beginning of some sort of pivot, in that we've had upper and lower wicks. Because what happens with the absence of a upper wick, it says that at no point during the trading session did prices move above the midpoint of the prior candle. And I correct myself from yesterday's show. When you start to see these wicks as we have over these last couple of trading days, it tells us it has moved into the midpoint and is not as strong. We also noted the fact that we have had reduced body sizes. However, when we look at today's candle, and this is this candle right here, what it tells us, we have an absence of upper wick, we have a medium-sized body, and it's telling us that it is less likely that we will see a key reversal or pivot, because we have a strengthening downward trend currently in play. And traders, this last chart we will look at for our gold analysis today is a three-line break chart. We've been using all three, candlesticks, three-line break, as well as Heikin Ashi, to get a collective picture of what we were witnessing. We are recognizing that we are at a key important level. That doesn't mean it will not be taken out, but if it is taken out, it indicates that we could see substantially lower pricing. The momentum will build. We currently have the three-line break candle. Below that, we have had days in which it has gone down on 3 consecutive occasions as small-bodied candles, and then 2 very, very large candles coming just before that at the top. You can consider this the pivotal candle. I would believe, all things being equal, that we could easily see a play for 1757 unless the fundamental events that have been driving this market lower change in any way. We have also been looking at the divergence between gold and silver pricing, saying that they're certainly at least beating to a different drummer. This is the 3-line break chart off of a daily chart. We can see that we do have a slight indication of possibly higher pricing. However, because the Japanese average chart is inherently a lagging indicator because it uses averages, it takes time before it catches up to real-time data. In the case of what we are seeing, we do have a continuation of the downtrend. This is today's candle. So when we look at the most recent activity, we can see that the majority of trading days had no upper wick. We did get one here as well as here. Today, this is just starting, so we will not include that in our analysis. While by no means can we derive that we've hit some sort of a bottom in silver based upon a candlestick chart, we do have a small doji candle in the star position, and it could indicate one of two things: either consolidation of price. You get that when you get these series of small-bodied candles, such as here. If tomorrow's trading activity resulted in a candle that was a large green candle, and that green candle would have to contain not only a higher high and a higher low, we would identify a 3-day pattern simply called a 3-river morning star. Also, if we take a look at where these lows came in and carry them over to historical data, we see that it quite eloquently matches up a period of consolidation that occurred a few months ago, right here. However, as of the time that we are recording this show, it is much too early to make any claim such as a potential bottom or that the market will continue to sell off, which, in my opinion, seems a little bit more likely. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.